All right, well, it is time, so we will go ahead and begin the introduction portion of this morning's webinar. KTC is very pleased and proud to be able to host this webinar and be able to talk today with James Calhoun from Accuvest Global Advisors on some views that Accuvest has and the processes that they use in choosing and selecting the portfolio strategy that they're going to use. Kodiak Trust Company is located in Alaska. We are licensed with the state of Alaska as a trust company. We're completely independent, and although we've worked with Accuvest Global Advisors for a lot of years, we are independent from them. We work with a number of other investment advisors, including some family office type, as well as large institutions, all the banks that you can imagine. The advantages of Alaska, as we see it, is one of the premier states for trusts. Between the top four states that specialize in trusts, Alaska has always been in the forefront, especially when it came to asset protection. We're recognized as having the best asset protection trusts within the United States. And in spite of the fact that Alaska is a very large state, the government and our regulators are very good to work with and have always looked to maintain Alaska's status as a leader in the trust industry. Kodiak Trust Company was formed in 2017. We specialize in families, particularly families in Latin America, as we have a lot of experience both with the culture and with the laws of Latin America pertaining to inheritance. And we work a lot with tax advisors within those countries, so we feel we have a pretty good understanding of the cross-border issues that many international families face. I first met James 10 years ago when he started working for Accuvest Global Advisors, and have always been impressed by our monthly investment committee meetings that we hold with them as he presents Accuvest Global Advisors view for the coming month or quarter. And so without any more fanfare, we'll go ahead and turn the time over to James for his presentation.
Thanks, Jeff. Kind words. Same to you. It's been a fast-paced 10 years. Interesting times for sure. I think we picked a good day for this meeting or this webinar, considering tomorrow is the Federal Reserve announcement, and there's quietly rumors starting to pick up about a potential for a 75 basis point hike, something we've never seen. So let's jump right in. We're gonna talk about some of the tools and processes that help advisors or can help advisors make better investment decisions in uncertain times. Get my laser pointer out here so you guys can follow some of my points. We'll start with just defining the current conditions of the market and some of the drivers behind what we see as a widening range of outcomes, especially right here in the near term. We'll talk about some strategic approaches to managing that backdrop in the market. So methods for the madness that we think are time tested and will serve advisors well, regardless of the market backdrop. Then we'll move into some of those tools and processes that will, we think, help advisors and portfolios adjust to changing market paradigms and new investment theses. And then we'll talk about models and the concern for us and what we see a lot in the industry is these assumptions around standard deviation and normal distributions for portfolios and asset class level returns. And in reality, that just doesn't prove out to be the case. So we'll define some of those assumptions and talk about again how these tools and processes can help mitigate some of the risks that come with leaning on those models. So first and foremost, uncertain times. Inflation here, CPI and core CPI breaking out to a historic high and trending strongly. And the question presents itself of just how far can inflation go here, and how do you manage portfolios to the risk of this continuing higher or inflecting and moving lower. So that's certainly the condition in the market that investors are highly focused on right now, the purchasing power of their portfolios and real returns after the effects of inflation. Some of those inflationary pressures are driven by other unprecedented events. This is on the left at the top, the federal net accumulated deficits, or the net debt for the U.S. government, and at a high that we haven't seen since World War II, and setting the table for what happens next. Furthermore, you see the deficit, the monthly spending of the US government at very, very high levels in the year of COVID and the year following COVID, as the US government really tried to step in and support the free market, let's say. And where this goes from here and what it means for consumption, the economy, and investor confidence is another outlier or another wide range of outcomes. Then there's the Federal Reserve and the monetary policy side of the equation, not just the government spending, but the historic and unprecedentedly low interest rates from the Federal Reserve after the financial crisis to present, and the expansion of their balance sheet. You can tell here that before the financial crisis, the Federal Reserve had not yet discovered their balance sheet as a tool for supporting markets. And so we are coming or potentially nearing the end of a very long period of what we would say is a central bank put. The global central banks backstopping risk within the markets, willing to step in, buy mortgages and buy treasuries and keep interest rates low in order to encourage confidence and investment. So obviously the level of the balance sheet here is very high relative to history, and the forecast going forward, the idea of letting the balance sheet roll off and what that means for asset classes and the interaction and correlations between asset classes is it just adds to the uncertainty. And investors are feeling it this year. Advisors, investors are surveying extremely bearish, more bearish than COVID, as bearish as 2008, and a lot of it has to do with how poorly fixed income is performing. Here you can see the Barclays aggregate bond index total return by year, and 2022 significantly underperforming any other year back to 1985, actually 1982 it appears, and even 77 here in some of these gray periods. So an outlier event for the performance of fixed income. And this is even more so challenging this year because we have equity selling off at the same time. So the traditional portfolio of stocks and bonds, where over the last 30, 40 years, if equities were selling off on recession risks or concerns about slower growth, you typically saw interest rates moving lower. This year, where we've seen stocks basically produce their fourth worst start to the year since 1928, and treasuries, a full basket of treasuries, the worst start of the year since 1973, you can understand the concern and bearishness coming out of advisor surveys and client and investor surveys. When you're losing on both stocks and bonds in your portfolio, the fatigue and the intellectual attractiveness of real being really bearish presents itself. And we'll talk about how we can manage against this all or nothing view of sell everything and go to cash. But the environment that we're in right now, with stocks and bonds both selling off, can really make investors feel like there's nowhere to go, nowhere to hide. But we are of the mindset and belief that with the right indicators and the right dashboards, listening to the market, there's a bull market everywhere at any time. So, or I'm sorry, there's a bull market somewhere at any time, not everywhere, obviously. So, very difficult investment environments with stocks and bonds selling off at the same time, and the questions of diversification present themselves when you don't have a portion of your portfolio that's proving resilient to the market backdrop. So, starting at the strategic level, things and methods for the madness, things that advisors can do, regardless of market backdrop, when the market begins behaving in this way. First and foremost, I would say maintaining some measure of optimism is important. Their capitalism has proved resilient historically when markets and bearishness is high, and you can take a long term perspective. That optimism has proved to be the better approach over or throughout history. So what we would how we would frame this is to try to avoid all or nothing thinking. Going from fully invested to zero investment, 100% cash, is a dangerous exercise. Timing the market has proved to be extremely difficult. The markets are moving faster than ever, as ETFs have proliferated. But we would say that you want to be incremental, and you want to be selective, and you want to discern where the opportunities are within asset classes. That's an important way to approach your investment thinking. Number two, of course, and obviously perhaps, is increasing diversification. There is still a lot of home country bias for U.S. investors. The U.S. market has meaningfully outperformed the rest of the world over the last 12 years, and investors have gotten comfortable with the resiliency and even the reserve currency of the US. And business cycles are in a different rhythm in different parts of the world. So diversifying your exposure to the US business cycle is a good place to start. But even within equities, thinking about different regions, but also different sectors and especially styles. The growth factor, the growth style of investing has meaningfully underperformed this year, and having a foothold in value relative to growth has proved to be a contributor to relative performance year to date. And then in fixed income, diversifying across maturities and being aware of relative strength across different maturities of fixed income, that's important. Different credit qualities, from AAA government to and inflation protected treasuries, which we would actually think of tips yields as the risk free rate for investors. And then segments, whether it's mortgages or high yield or investment grade bonds. All of those are key and important to keep in mind as you're building your fixed income portfolios. And then last but certainly not least, especially this year, is the diversification across asset classes. We talked about stocks and bonds being down this year, but there is a third asset class that we believe in. We would label it the alternative asset class, but it has more exposure to inflation and currency effects. Whereas equities are very dependent on the economic cycle and earnings, and interest rates obviously are impacted by interest rate levels and trends. This third asset class, which we believe diversifies the risk of interest rates and the economy, is the alternative asset class, where you can be allocated to currencies and commodities and real assets, as well as alternative strategies and alternative beta. So diversification certainly protects against the most ruinous outcomes. Third would be retaining flexibility. And this will be an important point for the remainder of the presentation. retaining flexibility, what's key here is maintaining investment liquidity. The liquidity of the markets has improved drastically over the last few decades, and tapping into the liquidity of your portfolio to incrementally reposition in the direction of what's working is an important tool when we're dealing with a wide range of outcomes and high uncertainty. And then last, we would say at the strategic level, we believe you should trust in the consumer. Especially in the US, the household's willingness to spend and propensity to spend is very resilient. Rarely do you see personal consumption retreat, even in a recession. What happens is it tends to shift towards the more inelastic demand goods, the staples, the energy, the apparel, the food. It can shift in that direction and away from big screen TVs and cars and your more discretionary purchases. So the patterns of consumption can shift, but the consumer and the households enjoyment from spending and consuming has proven to be very resilient through the last few market cycles. So we would say lean on brand relevancy and brand loyalty and and companies that have exhibited pricing power. Those are important identifiers for where to position some of your equity and fixed income exposures in times where default risk is going up or recession risk is increasing. So that takes us to how we can, or what tools we can use to make better investment decisions. Again, specifically in times when we're dealing with wider range of outcomes and very high uncertainty. I would call them when, I would label it as when the market paradigm seems to be shifting from something like decreasing interest rates to rising interest rates. So to manage and adjust portfolios, whether it's new money coming in or adjusting fully invested portfolios, first and foremost, we would say don't anticipate. Be careful calling a top in interest rates or a bottom in the stock market. We would rather, in this environment, choose to read and react, and along the way continue to confirm what we're seeing and what we're hearing from the market. So be very careful calling tops and bottoms, especially at the asset class level. Number two, being consistent and disciplined. That it doesn't make sense to put specific indicators and signals into your process and then not listen to them. So consistently reviewing and being disciplined about making incremental adjustments when you receive those signals is a key to success here. Third, we would say lean towards the persistence of the trend. When we get into the model section, you'll see normal distributions and this expectation towards mean reversion, which mean reversion is a phenomenon we do see in the market. It's just in the markets and in nature, it tends to be further out and at more extreme levels than what coin toss math or a normal distribution would suggest. And then fourth, staying alert to the market backdrop, understanding where potential market imbalances and bubbles may be is important for a risk control and keeping your adjustments to the portfolio measured and pointed in the right direction. So understanding where the excesses and the complacency lies and where valuation extremes are presenting themselves, that can help confirm some of the signals that we'll get into right now. So from a process perspective, these first two boxes at the top, defining an investment thesis and what the market paradigm is, and then identifying value extremes and secular themes, this could be debated in another setting. There are a multitude of ways to reach conclusions, and many different advisors will have various philosophies and approaches to the market. So let's set those two aside. But whether or not you believe interest rates are going to trend higher for the foreseeable future or lower, and revert back towards or back into the downtrend we've seen the last couple of decades, we believe these next 5 steps can be applied to whatever the conclusions of your advisor may be. And so to start at the top here, we would say you need to aggregate data, and the more real time it can be, the better. But at the asset class level, the main drivers of returns, whether it's interest rates or the currency or the yield curve, commodities, equities, there needs to be some attention paid to how those are performing. And then also within asset classes, where is the relative strength from a trend perspective? So building a market dashboard. Imagine flying through a foggy or a storm, and there's times like that in the market where all you have to lean on is your dashboard. And we would say that having a robust market monitor or dashboard and reviewing it on a regular basis is a key to getting through uncertain times. Next would be when you do get a trend signal, and there should be multiple trend signals. We do not subscribe to just a short-term signal or just a long-term signal. We want to have a robust sign, and an incremental sign at that, to use to adjust our portfolio. So upon a first signal, obviously reallocate, be disciplined, make an adjustment, use the liquidity of the markets appropriately, and use that trend signal to explore the robustness. Look for confirmations of that signal in other asset classes within the relative strength of asset classes. And then as that signal plays out, and let's say you receive a second confirmation signal, that would indicate another adjustment to the portfolio, moving the portfolio in the direction of what's working in the market, regardless of the narrative. Advisors and the echo chamber that is modern media will paste narratives to price action, and those narratives can sometimes create biases that make it harder to adjust portfolios in risk prudent directions. So again, on the next signal, automatically reallocate in a measured way. And that should trigger a review of your investment theses and assumptions. If you get two signals, let's say within interest rates, which we currently have in an uptrend, when you have the daily signal first and then the weekly signal confirming, it's time to test your assumptions and revisit your investment theses about the market paradigm. And then you can reevaluate and rework your way after that feedback loop through the rest of the cycle. And it's important for this macro market monitor or dashboard to evolve over time towards what, obviously there are some key drivers of returns that should always be evaluated, i.e. interest rates. But as the investor focus and the imbalances in the market adjust or evolve, so should your market dashboard. So to drill in a little deeper here, let's let's define trend following. Trend following attempts to capture a portion of the market move. So when I say don't anticipate, rather read and react, that is what a trend following signal is trying to do. It's trying to say, we're gonna let the market bottom and rebound. We will miss the ultimate low, but we are going to try to capture the middle of the move. And at the top may roll over, and we may experience the first increments of losses off of that peak. But we want to let evidence accumulate that there's an actual inflection point and that the trend is changing before we adjust. Furthermore, trend following often contains risk management tools like sell signals or trailing stops that will give you a binary read on an incremental adjustment in the direction of the trend. And then third, they very much try to react rather than be predictive to market movements. So let's look at a few of these over a couple of different time frames, just to give you a feel for what these can look like. First is interest rates over the last 50 years. Now, what you have here in green is one of our preferred trend following signals. This is called a trender. In green, it will only move higher. When it's in an uptrend, it will never retreat. So it incrementally ratchets higher to give you a tool to protect gains when you have a very persistent trend. Now, this is very slow moving. This is a long-term trender using quarterly data points, probably too slow moving for most advisors. And it's really here as an illustrative purpose of how long the downtrend has been for interest rates, and the fact that we still, after the recent rise, haven't quite gotten the, let's say, secular signal for higher interest rates. If we zoom in a little on this, which is highly advisable if it hasn't been made clear yet, multiple time frames for looking at trends is very important. So here is 5 years or 260 weeks, and you can see that, oh, despite the quarterly view having no signals, over the last 5 years, you went from an uptrend in interest rates to a downtrend in interest rates, and now we are in a new uptrend for interest rates. This is further confirmed by a daily signal over the last 150 days, where we have not seen a reversal despite hitting above 3% and pulling back, and touching above 2% and pulling back. This trend has persisted and held, with the use of this indicator. And it's been very tempting. I mean, you hit a 2% yield and start to see it pull back, or a 3% yield and see it pull back. It's tempting to use your intuition and anticipate that you've reached the high in interest rates. But a disciplined, emotionless rule like a trender or a trailing stop, it could be a moving average, it could be a trend line, it could be a MACD, or some other momentum oscillator that can give you these signals. But having the signal and reacting to the signal with discipline proves to work quite well over the medium and long term. Here's one for commodities. Again, here using monthly data points. And there is a price to be paid. Trend following has what we would call the ability to be whipsawed, where you'd be buying commodities up here and selling commodities up here, and this would be an expensive whipsaw. So we're not saying manage your entire portfolio based on trend following, but with satellite and tactical allocations, again, when uncertain times and wide ranges of outcomes are presenting themselves, this can offer you a way to diversify the core of your portfolios. If you recall, in 2008, one of the few hedge fund strategies that actually outperformed and generated positive returns in that environment was managed futures, or CTA strategies. And the reason that worked is because they were strictly disciplined trend followers. They were able to get short equities and long bonds and long volatility. And that really served, even a small allocation to a strategy like that really served to ballast portfolio volatility and give the portfolio a portion of diversification that was independent of the economic cycle or the direction of interest rates. Here, zooming into weeks, you can see we have a well pronounced and defined uptrend in commodities. And as we said at the outset, that alternative asset class that's really served investors well, which has been, in our case, largely allocated to commodities. This has provided somewhere to hide as stocks and bonds have both sold off. Without trend following, the conviction and the confidence to move into commodities after a very long bear market, that's 12 years or 13 years of a downtrend in commodities. It was tough to move portfolios in the direction of oil when oil during COVID was breaching $0 a barrel. So it helped us recognize that commodities were a place that were producing positive returns and had a nice trend emerging on the weekly basis, and then again over a daily basis. Next, I would say within asset classes, and here I'll just touch on that market backdrop and understanding where imbalances are, so that you can understand certain situations where you can expect the persistence of the trend to potentially last longer than you would expect. So here we have a relative strength, or sorry, a difference in the forward PE between the Russell 1000 growth in the US and the Russell 1000 value. And here, as we've emerged from the financial crisis, we've seen the FANG stocks, or US growth and tech and consumer discretionary stocks, really become expensive historically relative to value stocks, Russell 1000 value, which might include more energy and financials and industrials. That presents to us, an imbalance in the market. There is an opportunity potentially for value to outperform for a meaningful period of time, similar to what you saw after the dot-com bubble and into the financial crisis. So this is a relative strength chart with the same underlying investments, the Russell 1000 value and Russell 1000 growth. So as this line works higher, Russell 1000 value is outperforming Russell 1000 growth. And we, after the financial crisis, have seen again the value, the growth trade outperforming value all the way into COVID. And now, just most recently, with interest rates rising and the discount rate for some of those growth stocks ratcheting higher, the multiples of those growth companies and the valuations of those growth companies are contracting, and contracting faster than the value components of the US equity market. So commodities weren't a bad place to be so far year to date. Also being allocated to US value relative to US growth has helped portfolio relative returns. So there's a monthly signal. Again, weekly signals give you a little bit faster reaction time. And then, of course, daily signals. You've been in an uptrend for value all year. And despite some of these pullbacks, you have a firm or disciplined line in the sand that you can leverage to adjusting portfolios rather than having to lean on narratives or macro assumptions or instincts, let's say. Next, and the last example of trend following, and in this case, a large market imbalance, similar to growth stocks outperforming value stocks within the US, we've seen a similar time period of the valuations of international stocks getting very cheap relative to US stocks. So we're at about a 30% discount on the current PE ratio for the US versus the rest of the world. So all country world index x the United States has a PE ratio of 12.7 versus 18.1 for the S&P 500. So this is a trend here that has persisted way longer than most would have expected, and at more than two standard deviations beyond average for the discount. It presents itself as an imbalance. Now, anticipating this reversion in valuation, it could have came at one standard deviation. It could have came during COVID or at two standard deviations, and this trend could persist all the way to three. So again, managing this trend and the persistence of this relative valuation is at the heart of what we're emphasizing as a tool. And so you can see here, since 2008, you have a relative strength chart. So the US versus the rest of the world, and the US in the numerator in this case, as this line goes higher, that exhibits or suggests US outperformance. As we zoom in, we are starting to see some early or an emerging inflection point. Now, using incremental adjustments is important here, and looking for a confirmation also important. If you got the US dollar to roll over with US equities compared to the rest of the world, that's an interesting confirmation. If you saw emerging in international debt and credit markets beginning to outperform US credit markets, that adds to the robustness of the signal. So we've got some early indications that the rest of the world is starting to exhibit or realize its value proposition relative to the US. Same with a daily chart. Two shorter term signals suggesting that international is attractive and starting to show relative strength. but still quite a way to go for something that would be slower moving or secular. So why why does trend following present itself as a useful tool? Well, one warning or concern for us and what we've seen from other advisors and managers is this reliance on modern portfolio theory. And modern portfolio theory relies on normal distributions, or what I would label coin toss math, that every flip of the coin is independent of the previous. And in cases like that, you will get normal distribution and you will get mean reversion, but you'll also see three standard deviation events very rarely. And we've all experienced through COVID and even this year the potential for 4, 5, 6 standard deviation events. Those black swans, those outliers occur way more than our models in modern portfolio theory would suggest. So we could call that fatter tails or a wider empirical distribution. Secondly, I would say that asset returns cluster a lot like volatility, and the models don't really pick up on that. So here's an example of the actual realized experience for the S&P 500 in blue bars versus the normal distribution in red. So we have this taller peak. We see a lot of, let's say, quiet periods in the market where returns are calm and markets are trending smoothly. And then you have relatively less medium size outcomes, and then these fatter tails, more observations than you would expect for very bad outcomes, but also very good outcomes. And these fatter tails are at the heart of the idea of using trend following to manage and manage the risk and react to these wider outcomes. If commodities and oil prices want to go to 200, it's our job as advisors to participate in that. Whether the fundamentals agree or not, supply and demand imbalances aside, it's our job to recognize trends and participate in them in a prudent way for as long as they want to last, especially if we're talking about the fatter tails in the good direction. Furthermore, the downside risk, let's say with fixed income and equities this year, it's important to understand that the persistence of that trend, and again the range of outcomes for that performance can be quite a bit worse than your intuitive assumptions might be, i.e. flipping a coin over and over. You think, okay, we're due for heads if we've hit tails 10 times in a row. That's not the case in nature or in stock markets. So some of the assumptions that present this opportunity for trend following, and I'll be brief here. I don't want to turn this into a lecture on modern portfolio theory, but a key one is that again, price changes are normally distributed. That's not the case across a range of asset classes. You see 4, 5, 6 standard deviation events occur way more frequently than a normal distribution would suggest. Second would be that what happened yesterday doesn't impact today. This is that coin toss math assumption. That is not the case within asset class performance. There is some dependence short term with what happened yesterday or last month impacting how prices and markets perform today, and vice versa. Third here would be that investors are rational and aim only to get rich. Um, it proves out that people are not utility maximizing rational agents. There are misinterpretation of information. There are biases. The irrational behavior of investors has been well documented, but modern portfolio theory, the efficient frontier, standard deviation as a measure of volatility, all lean on that assumption, which we think leaves room for models to be broken or risk budgets and risk expectations to be blown out. Fourth would be that price changes are continuous. We've seen this year multiple times. You can wake up in the morning and there's a full reset of where prices are. It is not a smooth or continuous price price pattern. So big jumps up and down in asset classes also possible in the markets, but not assumed in most financial models. Last two here would be that price changes exhibit static stationarity. That's a mouthful, but again, it leans on the assumption that that participants are active in the market. When you think of the coin toss assumptions, the weighting of the coin that you're flipping in that game, let's say, is not adjusted. It does not change. But as we've seen with the Federal Reserve and government spending, and the arms race that is high frequency trading, or the evolution of strategies and where you can capture alpha in the market, whether that's value or low vol, those Fama French assumptions and the alpha that are generated by them have been arbitraged away. And that's because participants in the market are active and the game is evolving over time. And our current financial models don't pick up on that assumption. And then last is that time flows at a constant pace, at the speed of the calendar or a clock, when in fact we see clusters of very high speed markets where valuations reset in a very short period of time, and then other periods where the peak of those distributions of return are high in the middle. You have very calm and slow evolving markets at other times. And so the speed of the market is shifting under our feet, or depending on a variety of factors in the market. So a couple of faulty assumptions that we think leave room for mismanaging, or I should say misquantifying, the risk that may be present in your portfolio. So what do we do about this? Do we scrap everything and start from scratch? No, no, we wouldn't advise that. The analogy has been made. We made it to the moon using slide rules and not understanding quantum mechanics. You can achieve a lot with the modern portfolio theory. The idea of an efficient frontier and how to introduce diversification into your portfolio. Those can all hold true because the distribution of returns is close to normal. But we would say when you are adjusting portfolios or constructing a portfolio, or tranching a portfolio into its targets, you want to be aware of the occurrence of these 4, 5, and 6 standard deviation events. They seem to occur a lot more than often than you would expect with the traditional models. So we would say that you want to be aware of any trends that are in place and imbalances are in place, and use some of these rules to guide you in the direction of making better and smarter decisions. So we think advisors across the industry need to rethink the way they manage the range of outcomes and the frequency of disastrous returns, meaning significant and sharp sell-offs. And we would suggest that trend following across asset classes and within asset classes can help managers navigate portfolios better when these fat tails are presenting themselves, and you have potential paradigm shifts in the market. So I'll pause there, and leave you with the normal distribution versus empirical distribution, and see if there's any questions that I can help address.
Yeah, James, when at the beginning, especially when you were talking about bonds and equities, I go back to my economics classes with Professor Gardner, and the paradigm that you invested in bonds because during difficult equity times, the bonds would perform better. We've obviously seen that numerically be disproven, but where do investors turn right now? Do we parse the equity market and say, well, we're going to be in this part of equity, or
Good,
how do
good
we?
question. Yeah, good question. Well, this condition, the current condition in the market has accumulated over time. I would say that what we're dealing with right now is a low interest rate and high liquidity bubble. The near zero interest rates and in some cases negative real rates has enticed investors to concentrate in credit, chase yield, overweight equities, and at the same time, those manufactured low interest rates have made bonds expensive. And anytime you have the majority of your portfolio in expensive investments, there's a risk there. There's a risk of revaluation. And in some cases, at the same time, especially when rising interest rates inherently undermines the valuation of equities by raising the discount rate on those earnings and on those dividends. So I would say you got to go back to the philosophy that there's always a bull market somewhere. And the idea of trend following as a tool or a satellite or tactical strategy helps because there are asset classes that you can become exposed to without having to tear down your traditional portfolio. Yields moving higher lately reset the value and attractiveness of fixed income, and I think equities and the revaluation we've seen year to date has also, reset the valuation and the forward return expectations for equities. But if you can have a portion of your portfolio, that alternative asset class, and it depends on the risk appetite and objectives of your clients, 2 to 10 to 15% that can be allocated to what is working, meaning commodities as an example, or inverse equities, meaning hedging or being short equities. You can also get short treasuries or play for higher interest rates. And then last but not least is some alternative betas that are independent of the economic cycle and the level of interest rates. Things like merger arbitrage, which just captures the deal premium on mergers and acquisitions, or market neutral, which takes no equity beta but focuses on security selection. Those alternative betas can be ballast to the portfolio, and then being long the persistent trends or the confirmed trends, I should say, whether that's commodities, short equities through a hedge, playing for higher interest rates by being short treasuries, and then perhaps more dangerously, but also very effective, getting long volatility when correlations are rising and asset class volatility across the investment universe is going up. Being long volatility selectively is another opportunity. One caveat there: volatility does not trend the same way asset classes do. Volatility tends to cluster and spike. So I would say the tools that you use to manage the trends and volatility would be different than what you use for equities or interest rates or the relative strength within equities. Does that address or answer your question?
Doesn't tell me where to put my portfolio, but
Well, I would say that again, the method for the madness number one is don't take an all or nothing approach. Maintain some optimism about capitalism and the resiliency of the global economy. Stocks and bonds are going to have periods of drawdowns and volatility. That is why they produce positive returns throughout history and over time. So we would say cash as an asset class on the margin and these alternative asset classes are important pieces for the portfolio from a diversification perspective, but your main drivers of return still are going to be equities and yields off of fixed income portfolios. So tearing those down would be ill advised. I would just say incrementally moving those allocations in the direction of what is showing relative strength is the right way to go. So within equities, we would say value within the US relative to growth is attractive. And that international stocks relative to the US is starting to present itself as a pretty interesting opportunity, but that's not confirmed just yet. And then within fixed income, we're avoiding government debt, and we are leaning on very short maturities. So 1 to 4 years to maturity, and allocating towards more higher yielding investments like investment grade bonds, mortgages, or in certain situations, high yield bonds after we've seen interest rates reset to where they are today. So relative strength within the asset classes would be an important tool to use to guide you towards what's working. We've had a very long period of Facebook, Amazon, Google, Apple dominating the U.S. market, and it would make sense that that extended trend has the potential to inflect and present an opportunity in the other direction. And that's what we're monitoring. And as it's confirmed, we will be adjusting portfolios in that direction, one way or the other. If growth wants to represent itself as relative strength, let's say, for example, we enter a more recessionary backdrop where growth is scarce, there's a case to be made that growth stocks would be more attractive in that environment, especially if interest rates begin moving lower. But we don't see interest rates moving lower, which continues to point us in the direction of value and companies that are more exposed to or more leveraged to the global economy.
Thanks, James. Any other questions? We're right on our 1 hour mark, so we want to make sure that those who have questions have a chance. You can always email James. His contact information is in the invite, and we appreciate everybody being here and look forward to seeing you in our next webinar. Thanks a lot, James. Appreciate your time.
Thanks, Jeff. Same to you. Thanks.